Welcome to the Big Four Accounting Firms podcast, brought to you by big4accountingfirms.com. Today's podcast, I wanted to discuss the collapse of FTX, the failed crypto exchange. It's pretty big news, and I think it has potential to have a big impact on accounting. Right now, I think the accountants are lucky and they're not in the spotlight, but eventually they will be, as they always are, as everybody looks around for the rich people to blame. And they're going to look for companies that have money. And that's going to be the accounting firms. Now, here with FTX, they claim to have been audited. And SBF, Sam Bankman Fried, he tweeted last year that they're the first crypto derivatives exchange to complete a gap audit. But we have to remember he's a natural born liar. So who knows what's happened? They even claim this on their website. And people found that it's probably Prager Metis and Armanino. People aren't sure, and there's an FT article about it, what extent they were audited. But obviously, it wasn't too extensive because these guys were spending money like crazy on various political campaigns, on charity, just giving the money away. And they were over leveraged as well. The SBF guy, he went on a tweet rampage this week about how, he's trying to do the best by the customers, and he didn't actually know they had $13 billion of leverage. He thought it was more like $5. But I mean, if you have an audit, theoretically, this guy signed off on that audit. He should be signing off on a lot of things. So for him to say that, and people are saying like he shouldn't have put that in a tweet because it just proves that he's incompetent, and maybe that's what he's hoping for. But to say that you're the CEO or the founder of this company and you didn't know what's going on from a leverage standpoint by billions of dollars, that's insane. But there's so many layers to this story. But one of the biggest ones is that they just apparently just used customers' money to do whatever they wanted, hiring their friends, buying houses for each other. And the latest news is the liquidator, the guy that's in charge of the bankruptcy, he said that he's never seen anything this bad. And he was the same person that was in charge of Enron. And we all know how Enron changed the accounting landscape. The U.S. federal government basically gave the death penalty to Arthur Andersen, which was one of the big 5 accounting firms at the time. And eventually, some of that was overturned by the Supreme Court. But before it was too late, and Arthur Andersen went over. I think there's a ton of liability for these 2 accounting firms. People are making fun of the Prager Metis because apparently they have like a nightclub or club parties in the metaverse and Facebook. So I think these 2 accounting firms, I don't know if the U.S. regulators will give them the death penalty. I think it's hard to do that again, but there will probably be a deferred prosecution agreement similar to what KPMG has. I think there's going to be something similar to that. There's going to have to be. But if that's if these guys don't get pulled in, but we still don't know the extent of their involvement, like how extensive their audit was. Like it could be, just one simple entity they signed off on, not like FTX at a consolidated level. It's still unclear. And PwC has been put in charge of parts of the liquidation in the Bahamas. So this is a complex wind down of FTX that's going to happen here, and there's a lot to be figured out. But I guarantee some of this is going to come back to the accountants, unless this guy is lying and nothing was actually done. But if there was something actually done and the accountants didn't do their jobs, and this is going to be another case of more regulation for accountants coming out of this. Still more to be seen, but we have to remember that Enron and Sarbanes-Oxley completely changed the industry for accounting. We don't know, the guy that has the history with Enron, that's in charge of the bankruptcy. He's saying he's never seen the lack of controls, the just overlooking any controls, how closely held the company was by friends, and just nobody asking questions up and down. I mean, they if they actually had $13 billion of loans, somebody gave them those loans, and even Sequoia Capital was involved in this. Good, smart investors were involved in this thing and got wiped out. One of the people from Shark Tank was on here and involved in this. So it's just it's a pretty insane story. How many people were duped? But it's just also nobody did their due diligence in any step of this. And potentially the accountants didn't either. So this has the potential to change the industry. And it goes back to one of the things I always say. People have to make sure they're checking cash. Because if you check this company's cash, you would have seen us flying out the door. And it's flying out the door, and they're using it for personal expenses. All you have to do is dig in a little bit to some of these transactions and figure out that they weren't, that it's not expenses. I mean, especially the amount that these people were spending on themselves. They did this in a short period of time and just ran this company into the ground. And so there's going to be a lot more regulation, I think, in the crypto space as a result of this, which was convenient because this guy was pretty buddy with regulators too. And then there's also going to be potentially more accounting regulation, or at least oversight. And I think this is why the Big Four, this is why EY is trying to split up, because they see where all of this is headed. There's all these collapses. A recession is coming if it's not already here, and companies are going to go under. And the Big Four accounting firms know they're going to be blamed for it. And so, they just want to separate the audit from the consulting. But it's also you can't just blame audit companies for company failures. That won't work either. And I think another thing that the Big Four accounting firms can do to help themselves out in this situation is bring up, if I was them, I'd bring up that they weren't the ones accounting this company and that their standards are much higher. I would use this to my advantage if I was the Big Four accounting firms. Even though it's not the Big Four accounting firms mess up all the time, they need to take credit where credit is due. And here they didn't actually, audit this. It was a smaller firm. So the Big Four accounting firms can stress the importance of their work by showing how these smaller accounting firms just completely ignored the warning signs here. If that's the case, we still have to see, we still have to learn more. This is an interesting thing. That's why I hopped on and wanted to create a quick podcast about this. This is important. It's interesting. It's interesting from a financial perspective, from an audit perspective, from how it's going to impact the accounting future. It's just how it's going to impact crypto in the future. There's just too many implications for the Big Four accounting firms here. But that's the podcast for today. Make sure to subscribe to this podcast and check out the show notes for useful links. Thanks for listening.